Imagine that in the late 1990s, someone told you that in the future people would use something called the internet to shop, watch movies, video chat with people all over the world, and even complete work online. You might have thought it sounded a bit far-fetched at the time. Today, we are standing at a similar crossroads, except that the protagonist this time is cryptocurrency, and the blockchain technology behind it. Don't think that cryptocurrencies are only about the currency circle. You don't have the energy or interest to study these things. Just do your stock investment well. This idea was understandable in the past. After all, the crypto market is parallel to the traditional capital market, and they can keep their distance from each other. But now the situation has changed. The currency circle has extended its tentacles to the traditional capital market, and the two capital markets are moving towards integration. Some time ago, the stablecoin issuer circle, after its listing, saw a surge in its stock price, which showed us that a new era of investment has arrived. Whether you understand the cryptocurrency market now or not, you should clearly see that the traditional capital market will usher in an encrypted transformation. Investors who don't understand cryptocurrency are like a sprinter without an arm. Although they can also participate in the game, this is obviously an asymmetric competition. Therefore, it is particularly important to learn about this aspect. I know very little about this aspect, so I can learn and discuss it with friends who are interested. When many people hear about cryptocurrency, what comes to mind may be the roller coaster-like price of Bitcoin, or some complex codes. This can easily make people feel that this is just a digital game for geeks, or a high-risk speculative bubble that has nothing to do with our daily lives. But if we only stay at this level, we may miss a new world that is quietly forming in parallel to our existing financial system. This new world is not only about investment, but also about how we will transfer money, how to pay, how to borrow, and even how to pay employees in the future. It is building a new set of underlying financial logic. Therefore, understanding this new world is no longer an optional, but a compulsory course to help us understand the future financial landscape. Today, we will start with the most critical and basic component of this new world, stablecoin, and use the most easy-to-understand way to unveil the veil of this parallel financial world step by step. To understand stablecoins, we must first start with its source, which is the famous Bitcoin. After the 2008 financial crisis, a mysterious person, or group, who called himself Satoshi Nakamoto, published a paper proposing a brand new electronic cash system, Bitcoin. Its core idea is simple: to create a digital currency that is not controlled by any country, bank or company and can flow freely around the world. This is like creating gold in the digital world. Its quantity is capped, the total amount is limited to 21 million, and it is easy to divide. The minimum unit of transaction can be 0.0001, and it can be sent directly from one person to another point to point without any bank as an intermediary. This is a revolutionary idea. For the first time, it allows people to see that value can be transmitted on the global internet without a centralized institution, just like information. However, Bitcoin also exposes a huge problem: price volatility. Its price may rise or fall by 10% or more in a day. It's like you buy a car with 1 Bitcoin today, and find out tomorrow that its value is enough to buy a house, or conversely, it is only enough to buy a bicycle. Obviously, no one would be willing to use such an unstable currency to buy daily necessities or as a salary. This problem limits the cryptocurrency from becoming a real currency. So, the crypto world began a new exploration. If Bitcoin is like a single-function calculator that can only handle simple calculations such as a transfers X coins to B, then Ethereum, which was born in 2015, is like a powerful smartphone that can run a variety of applications. Ethereum introduced a concept called smart contract. You can think of it as a piece of automatically executed, tamper-proof program code deployed on the blockchain. When certain preset conditions are met, this code will be automatically executed. This innovation opened up a whole new world. Developers began to build various decentralized applications on Ethereum. For example, decentralized exchange (DEX) users can trade cryptocurrencies directly with each other, and their assets are always in their own hands without the need to be entrusted to centralized platforms such as Binance or Coinbase. There are also decentralized lending platforms. You can deposit your own crypto assets in a fund pool and lend them to others to earn interest. Conversely, you can also pledge your assets and borrow money from the pool. The whole process is automatically handled by smart contracts, which is efficient and transparent. People also thought of using it for cross-border payments, salary payments, and issuing digital certificates for real-world assets, such as real estate and artworks, so that they can also be traded on the blockchain. As society's recognition of the new thing of cryptocurrency gradually increases, governments have also relaxed some regulations on the industry, especially the Genius Act recently proposed by the United States, which allows real-world assets to be legally traded in the cryptocurrency market, breaking down the barriers between the two markets. So we saw a parallel, decentralized financial ecosystem begin to flourish, that is, what we often call DeFi, decentralized finance. This parallel financial world is becoming more and more prosperous, but there is always a value gap between it and the real world. You can't use US dollars or euros directly in the DeFi world, and the prices of native crypto assets such as Bitcoin and Ethereum are extremely unstable. It's like you want to do business in a large online game world, but the gold coins in the game and the currency in the real world cannot be stably exchanged, so it's naturally difficult to expand your business. We need an anchor, a measure of value, a bridge that can stably introduce the value of the real world into the crypto world. This bridge is stablecoin. Stablecoins, as the name implies, are cryptocurrencies with relatively stable values. Their goal is to maintain price stability by pegging them to some real-world asset, most commonly the US dollar, usually at a 1-to-1 ratio. You can think of it as casino chips. You exchange $100 for 100 chips, which you can use to play various games in the casino, trading, participating in DeFi, etc. in the crypto world. When you are ready to leave, you can exchange the 100 chips back for $100. As long as the casino is reputable, the value of the chips will always be equal to the value of the US dollar. Stablecoins are the dollar chips in the crypto world. It is precisely because of this feature that stablecoins have become an indispensable and key component of the crypto market and are the preferred tool for investors to seek hedging and stable value storage when the market fluctuates violently. According to the supporting assets and issuance methods behind them, stablecoins can be mainly divided into the following categories. Type 1, Fiat collateralized stablecoins. This is the most mainstream and largest type of stablecoin on the market. Their operating principle is like the casino chip model we mentioned earlier, which is also the easiest to understand. Typical representatives, USDT, Tether, USDC, US dollar coin. Its core principle, issued by a centralized company or institution. If users want to obtain this stable coin, they need to deposit an equal amount of legal currency, such as US dollars, to the issuer. For example, if you wire $1,000 to Tether, the issuer of USDT, Tether will mint 1,000 USDT for you on the blockchain. Conversely, when you return 1,000 USDT to Tether, they will destroy these USDT and return you $1,000. So what is the mechanism behind this stability? In theory, every legal currency received by the issuer will be deposited in a bank or purchased into highly liquid, low-risk assets, such as US short-term treasury bonds, as reserves. As long as the reserves are sufficient, the ability of stablecoins to exchange with legal currencies at a 1-to-1 ratio can be guaranteed, thereby maintaining their price stability. For example, Circle, the issuer of USDC, regularly publishes reports issued by independent auditing agencies, detailing the composition of its reserves, most of which are cash and short-term US Treasury bonds, to enhance transparency and market confidence. To give an image, a fiat collateralized stablecoin is like a digital dollar wallet in your mobile phone, where an institution similar to a bank holds an equivalent amount of real dollars for you. The numbers in the wallet can be easily circulated in the crypto world, and the real assets behind it guarantee its value. Type 2, Crypto-collateralized stablecoins. This type of stablecoin emerged to solve the problem of fiat collateralized stablecoins being too centralized. They do not rely on a certain company or bank, but are completely run through decentralized smart contracts. Typical representative, DAI. DAI is issued and managed by a decentralized autonomous organization called MakerDAO. Instead of depositing US dollars, users use other crypto assets, mainly Ethereum ETH, as collateral and lock them into smart contracts to borrow DAI. Its stability comes from the over-collateralization mechanism. Because the price of the collateral, such as Ethereum ETH, itself is volatile, in order to cope with the risk of its price falling, the system requires that the value of the collateral must be much higher than the value of the DAI you borrowed. For example, you may need to pledge ETH worth $150 to borrow 100 DAI, collateral ratio of 150%. If the price of ETH falls, causing the value of your collateral to approach the liquidation line, such as $110, the smart contract will automatically start the liquidation process and sell your collateral to repay the DAI you borrow to ensure the safety of the funds of the entire system and avoid bad debts. Crypto-asset collateral stablecoins are like a fully automatic, decentralized pawn shop. For example, you pawn a gold watch worth 1,500 yuan, and the pawn shop automatically lends you 1,000 yuan in cash. The extra 500 yuan is to prevent the price of gold from falling. If the price of gold really falls sharply, the pawn shop will automatically sell your gold watch and recover the 1,000 yuan it lent you. There is no pawn shop owner in the whole process, and it is all automatically executed by code. Type 3, Algorithmic Stablecoins. This is the most ambitious and controversial category. They try to rely entirely on no collateral, whether it is fiat currency or crypto assets, but purely through algorithms to adjust supply and demand and maintain price stability. Typical representative, FRAX. The mechanism of algorithmic stablecoins is usually more complicated. In simple terms, it will design a dual token system. One is the stablecoin we want to stabilize, such as FRAX, and the other is an equity token used to absorb price fluctuations. When the price of a stablecoin is higher than $1, it means that the market demand is too large, and the algorithm will encourage users to issue new stablecoins to increase supply and push the price back to $1. When the price is lower than $1, it means that the market is oversupplied, and the algorithm will incentivize users to destroy stablecoins to reduce supply and pull the price back to $1. Its stability depends entirely on the market's confidence in this algorithm. As long as everyone believes that this mechanism can continue to work, that is, believe that the currency value can always be maintained at $1, it can remain stable. However, once the market panics and a large-scale sell-off occurs, this confidence may collapse, and holders will leave the market regardless of losses. At this time, the algorithm cannot overcome human fear, and the price of stablecoins will plummet, resulting in the so-called death spiral. The collapse of UST, once the third largest stablecoin, is a painful lesson. Algorithmic stablecoins are like a micro-central bank, controlled by code. It has no collateral, but regulates currency prices through open market operations such as printing money, increasing supply, and buying back, reducing supply. But the credibility of this central bank is entirely based on everyone's trust in it. Once trust collapses, the consequences will be disastrous. In this way, the algorithm has huge flaws. It does not take into account that human greed and fear can make humans behave irrationally, but this is an unavoidable weakness of humans, and it is even less likely that the algorithm can solve it. Type 4, Real-world asset collateralized stablecoins. In addition to the US dollar, there are other valuable stable assets in the real world, such as gold. This type of stablecoin is to digitize these physical assets. Typical representative, PX Gold. Each PXG token represents ownership of 1 ounce of physical gold stored in a professional vault. The issuer, Paxos, is regulated and regularly audited to ensure that the tokens correspond to the gold reserves. PXG is like a digital, gold warehouse receipt. You no longer have to go to the gold shop to buy heavy gold bars and worry about how to keep them. You only need to hold PXG tokens in the crypto world, which is equivalent to owning the same amount of gold. You can trade this warehouse receipt anytime, anywhere, and even use it to pay, which greatly improves the liquidity of gold. Type 5, Synthetic Stablecoins. Synthetic stablecoins are the latest frontier exploration in the field of stablecoins. They do not rely on traditional US dollar reserves, but synthesize an asset pegged to the US dollar through complex financial engineering. The core is to hedge the price volatility risk of the underlying assets by holding a basket of long positions in crypto assets and opening an equivalent short position in the derivatives market at the same time, thereby achieving value stability. Typical representative, USD. Its operating mechanism is exquisite. The protocol accepts users' crypto assets, such as staked Ethereum STPH, as collateral, which is the long part of its balance sheet. At the same time, the protocol will open a short position of ETH perpetual contract on a centralized derivatives exchange with the exact value of the collateral 25. This combination of long spot plus short futures is called a delta neutral strategy. The effect is that whether the market price of ETH rises or falls, the profit, or loss, on the spot side will be completely offset by the loss, or profit, on the futures side, so that the total value of the entire collateral portfolio remains stable, thereby supporting the 1:1 peg between USD and the US dollar. This innovative model also comes with unique risks. The most important risk is the funding rate risk. When the market is extremely panicked, short selling sentiment will dominate, and the funding rate may become negative. At that time, Athena will need to pay fees to the long side in return, which will erode the protocol's income and even principal. Other risks include exchange counterparty risk, derivatives exchanges go bankrupt or get stolen, custody risk, although assets are held off-chain, there is still operational risk, and liquidity risk. When the market fluctuates drastically, large-scale redemption requests may make it difficult for the protocol to smoothly close its large futures positions. The current stablecoins are mainly of the above types. Through these different mechanisms, stablecoins have successfully established value havens in the turbulent ocean of cryptocurrencies, and have become a vital bridge connecting the crypto world and the real-world financial system. Okay, let's stop here and continue next time.